Hi class, welcome to Module 2, Borrowing Basics. This module describes how credit works and helps determine if students are ready to apply for credit. Sooner or later, almost everyone needs to borrow money. When used wisely, credit can benefit you and your family. But first, there's some things you should know about the value of credit and its costs. This module will help you decide when and how to use credit. In this module, we'll define credit and loan, distinguish between secured and unsecured loans, identify 3 types of loans, identify the costs associated with getting a loan, and identify the factors lenders use to make loan decisions. We'll explain why installment loans cost less than rent-to-own services. We'll explain why it's important to be wary of rent-to-own services, payday loans, and refund anticipation loans. And we'll describe how to guard against predatory lending practices. If you ask a financial professional what credit is, which of these do you think he or she would say? Money given to you that you don't have to pay back? Money you borrow to pay for things that you must pay back? Recognition for a job well done? Or the scrolling text at the end of a movie? If you said money you borrow to pay for things but must also pay back, you're correct. Credit is the ability to borrow money. When you borrow money on credit, you get a loan. You make a promise to pay back the money you borrowed plus some extra. The extra amount is part of the cost of borrowing money. This cost is also called interest. If you use credit carefully, it can be very useful to you. Not being careful in the way you use credit can cause problems, though. The type of credit we'll talk about in this course is personal or consumer credit. Credit for businesses or commercial purposes will not be covered during this course. Any money you borrow must fit into your type of budget. And Module 4 will help you create and follow a budget. You probably heard the term good credit. And having good credit means that you make your loan payments on time to repay the money you owe. If you have a good credit record, it'll be easier to borrow money in the future. However, if you have problems using credit responsibly, it will be harder to borrow money in the future. Why do you think credit is important? Well, credit is important because it can be useful in times of emergency, is more convenient than carrying large amounts of cash, it allows you to make large purchases such as cars or houses and pay for it over time. It can also affect your ability to obtain employment, housing, and insurance based on how you manage it. Credit is often secured by collateral or a guarantee. Lenders take a risk to lend you money, therefore they want to be sure that their money is secure. Collateral is security you provide the lender. Example, you pledge an asset you own, such as your home, to the lender with the agreement that it will be used as repayment if you cannot repay the loan. Let's discuss some important credit terms that come up quite often. A guarantee is a form of collateral. Example, co-signing is a form of guaranteeing a loan. If a person with no credit history asks another person to co-sign a loan, the co-signer is equally responsible and has to pay if the borrower defaults. In a secured loan, the borrower offers collateral for the loan. Example, collateral is given up to the lender if the loan is not paid back. Home equity loans and home equity lines of credits are examples. We'll talk about those more in a later module. An unsecured loan is not backed by collateral. Example, credit cards are often unsecured loans, although some are secured. Other examples include personal and student loans. An asset is something valuable that you own, like a car, savings and investment accounts, and property such as your home, if you have one. Can you think of any other assets that could be used to secure a loan? Well, I'll tell you some items generally not used as collateral, unless they're used to secure the purchase of that item itself. These include furniture for your home, clothing, and kitchenware. Let's talk about the different types of loans that you can get. A consumer installment loan is used to pay for personal expenses for you and your family. Examples are auto loans, whereby the automobile you're purchasing is used as collateral for the loan, and then there are also unsecured loans for short-term needs, such as buying a computer. Next, credit cards. Credit cards give you the ongoing ability to borrow money for household, family, and other personal expenses. Having a credit card allows you to buy things without actually having the money right away. Remember that if you're not careful in your spending, though, you can get into big trouble and could be burdened with quite a bit of debt. So be sure that you're able to make at least the monthly minimum payment on your credit card bill. As we established, credit borrowed must be repaid. When you get a loan, there are generally 2 costs you must pay: fees and interest. Fees are charged by financial institutions for activities such as reviewing your loan application and servicing the account. A credit card company might charge you an annual maintenance fee of $30, a service fee when you get a cash advance, or a penalty fee for charging over your credit limit. A lender might charge a $30 late fee when you do not pay your bill on time. Interest is the amount of money a financial institution charges for allowing you to use its money. The interest rate can be either fixed or variable. Fixed rates stay the same throughout the term of the loan, except in the case of credit cards where the rates may be changed if the bank gives you a required notice. Variable rates might change during the loan term. The loan agreement will show you the details of the rate changes. Credit terms can be confusing because of the various rates and fees lenders charge. The Federal Truth in Lending Act requires banks to state charges in a clear and uniform manner so you can compare the actual cost of borrowing. For a closed-ended loan, such as when you borrow a set sum of money to purchase a car, lenders are required by law to disclose the amount financed, the amount the loan the lender is letting you borrow. So let's say, use an example and say you're borrowing $5,000 for 1 year. The annual percentage rate, which is the cost of your loan expressed as a yearly percentage rate. For example, the APR is 12%. The APR reflects the total cost of lending rather than just the interest charge. It's the primary tool you should use to compare lending options. The law generally requires that the APR appear in bold 18-point font on most credit card applications so it's easily seen. The penalty APR is the APR charged on new transactions if you trigger the penalty terms in your credit card contract. Your credit card issuer may consider you in default if you pay late, go over your credit limit, or if your check is returned. These rates are usually higher than your standard or introductory rates. If you become more than 60 days late, the penalty APR may be applied to your existing balance. The financing charges are the total dollar amounts the loan will cost you. They include items such as interest, service charge, and loan fees. For this example, the finance charge total is 12% of $5,000 or $600. The total payment is the amount you will have to pay after you've made all payments as scheduled. For example, the total payment including the original amount borrowed plus the interest is $5,600. Here, the loan is for 1 year, but if the length of the loan is longer, the monthly payments will be lower. However, you'll end up paying more in interest in the end. Those were some of the basics of lending and credit. Now let's take a look at some services you need to be careful of and catch a glimpse into the true cost of alternative financial services. Getting credit is not cheap. However, getting a bank loan is usually less expensive than the following alternatives we'll be discussing over the next few slides. Rent-to-own services. Rent-to-own services let you use an item for a period of time by making monthly or weekly payments. If you want to purchase the item, your rental payments will be partly credited toward the purchase price. The store will set up a plan for you to rent the item until you pay enough to own it. If you choose not to purchase the item, you would simply be renting the item to be returned at the end of the rental period. Keep in mind the store is the legal owner of the item until you make the final payment. If you miss a payment, the store can take the item back. If this happens, you'll not own the item and you'll not get your money back. Rent-to-own agreements are technically not loans, so no interest is charged. However, the difference between the cash price, if you were to buy the item outright that day, and your total payment, the total of your rental payments over time, is similar to the interest you pay on a loan. Generally, using rent-to-own services are more expensive, sometimes much more expensive than getting a consumer installment loan to buy the item. Payday loans are short-term loans, usually up to 2 weeks. You write a post-dated check and receive cash that day. The loan service cashes the check on your payday to pay the loan in full. You can also go into the loan office and pay your loan with cash, at which point the lender returns your uncashed check to you. You must be careful with payday loans. They're usually made to people who need money right away and plan to pay it back with their next paycheck. However, if you're unable or unwilling to repay the loan when it's due, you may pay more fees to get another payday loan. Payday loans can be much more costly than they appear at first glance. If you don't have the money to pay the loan within the agreed upon time period, the lender may renew the loan and charge you additional fees. This will increase the total amount that you owe. Let's look at an example of how payday loan services work. Assume you go to a payday lender and you borrow $200. The term of the loan is 2 weeks. A fee of $30 is charged. In this case, you'd write a check for $230. The APR estimate for this transaction is 391%. An APR for a typical payday loan may vary and may be even higher than this example. Most payday lenders allow you to roll over or renew your loan, charge an additional fee for renewal, this time for $260, to $230 plus a $30 additional fee. And they're usually not federally insured financial institutions or closely monitored by the government like banks are. Asking a bank or credit union about their loan options would be a much better choice. Refund anticipation loans are short-term loans secured by your income tax return. Although the business preparing your income tax will give you the money, you're actually receiving a loan from a bank or a finance company. You may not realize how much this loan is really costing you because you do not have to pay any fees associated with obtaining a refund anticipation loan at the time you receive the money. For example, let's say your refund is $1,500. The fees associated with filing your income tax return with the tax prep service and getting the refund anticipation loan equal $300. You'll receive a check for $1,200. You're actually paying $300 in fees to obtain your income tax return. It's important to remember that the paperwork you sign to receive a refund anticipation loan will legally obligate you to repay a $1,500 loan. So if your actual refund is only $800, you're responsible for repaying $700 plus interest to the lender that made the refund anticipation loan. Also remember, the higher the loan amount, the higher the refund anticipation loan fee will be. This table shows some typical costs associated with getting a refund anticipation loan. You have the tax preparation fee, $100, the refund anticipation fee, $75, the electronic filing fee, $40, and the document preparation fee, $33. Total cost, $248. When you electronically e-file your tax return and request direct deposit, your refund is often deposited into your bank account within 2 weeks. Sometimes refund anticipation loans take just as long, yet cost you substantially more money. Many organizations host volunteer income tax assistance VITA sites. VITA is an Internal Revenue Service, IRS, coordinated program that provides free income tax assistance and e-filing. Income eligibility restrictions may apply, but contact the IRS for a location near you. Don't give your hard-earned money away. Find a free resource and save. We'll cover this a bit more in Module 4, though. Now that we know more about loans and the services to be careful of, let's look at other options for when you need emergency cash. Imagine this scenario. It's 2 weeks until payday, your credit cards are maxed out, and your car breaks down. You only need a few $100s for the repairs, but you need it now. Where can you get the money? Many people in these situations have turned to alternative financial service providers like pawn shops, car title lenders for a loan secured by the borrower's car, payday lenders for unsecured loans that borrowers promise to repay out of their next paycheck or regular income payment. While many non-bank lenders advertise quick and easy cash, their services tend to come at a steep price. Next up, we'll look at some tips for finding emergency cash at affordable prices. When you need money fast, could you borrow it from yourself? The best way to avoid a cash crunch is to put money into an emergency savings account that you can use to pay for unforeseen expenses. This involves saving for the unexpected. It's hard to do, but it's the wisest solution. You might even link a savings account to your checking account to protect yourself if you were to ever overdraw that checking account. If saving money seems impossible, consider making small, simple changes in your habits or banking practices. Possibilities include having your paycheck directly deposited into your checking account, with a portion automatically placed into an emergency savings account. Comparison shopping is another possible solution. If you do need to borrow money, it pays to comparison shop. When comparison shopping for loans, look at both total dollar costs and the APR. Payday lenders, for example, typically charge about $15 for every $100 borrowed. So on a $500 loan for 2 weeks, you'd pay $75 in interest. Now that might not sound like a lot of money to pay for a small loan, but it translates to a whopping 391% APR. If you renew or roll over the $500 loan for another 2 weeks, you pay an additional $75 in fees. At that rate, in just 14 weeks, you'll owe more in fees, about $525 worth, than the original loan. Can you think of any other ways you can save or build an emergency fund? Does your financial institution offer emergency cash options? If you find that you must borrow money, beware of alternative financial service providers that may promise quick cash. As we just saw, services such as payday loans or car title loans come at a steep price and can trap you in debt. Many banks offer reasonably priced small loans that enable you to borrow money and repay the money, plus interest, later. Talk to financial institutions in your community to see what options they may offer. One example is a line of credit, which you can use to borrow money for a short period of time. It's best to work with your bank to set up this type of account in advance, instead of waiting until you're in a rush for cash. As with any other line of credit, you'll be told the APR before signing a formal agreement. Be cautious of using fee-based overdraft programs to deliberately overdraw your account if you need cash quickly. The costs can quickly add up depending on the number of transactions covered. Ultimately, it's just a good idea to open and build up a savings fund to cover unexpected expenses. That way you can borrow from yourself and avoid paying interest and fees. One last thing while we're on this slide. Did you know that the Boise State Dean of Students Office has a Student Emergency Fund? The Student Emergency Fund provides financial assistance to Boise State University students who are in danger from withdrawing due to unanticipated temporary financial hardships resulting from emergency or crisis situations, such as accidents, illnesses, deaths of family members. Funds will be awarded as grants to help alleviate short-term financial needs. Eligible expenses include medical, dental, housing, rent, utilities, books, school supplies, food, groceries, personal automobile and travel needs, and childcare. There's an application process and some important stipulations and criteria you must meet, so I encourage you to check out their site for more information. The address is listed in the slide. Don't be a buckless bronco. So let's look at how banks decide to lend money. A helpful way to think about this is by remembering the 4 C's: capacity, capital, character, and collateral. When you apply for credit, the lender will review the 4 C's to decide whether you're a good credit risk, or in other words, whether you're likely to pay back the loan. Capacity refers to your present and future ability to meet your payments. Capital refers to the value of your assets and your net worth. Character refers to how you have paid your bills or debts in the past. And collateral refers to property or assets offered to secure the loan. First, let's discuss capacity. The lender may consider how long you've been in your job. Generally, a lender would like to see that you've held the same job or some same type of job for at least a year. How much money do you make each month? What are your monthly expenses? A bank will compare the amount you owe and your other monthly expenses with your monthly income. This is called a debt-to-income ratio. It helps determine how much money you can afford to borrow. The bank wants to ensure that your expenses are not too high for you to take on the additional monthly debt of a loan payment. They want to be sure you can repay what they lend. For capital, the lender may ask, how much money do you have in your checking and savings accounts? Lenders may want to know if you can manage your money well enough to take on a loan. Do you own a house? Homeownership means you have equity or secured savings in case you cannot pay your loan. Do you have investments or other assets, such as a car? Lenders may want to determine the value of your assets. Lenders will also compare the difference between the value of your assets and the amount of debt you have. This is called net worth. A positive net worth demonstrates your ability to manage your money. Regarding your character, the lender may seek answers to the following questions. Have you had credit in the past? If you have a good credit history of repaying your other loans, you'll have an easier time getting your loan request approved. How many credit accounts do you have? If you've never had a credit account, you may have difficulty getting approved for a loan. Having a good credit history shows a lender you can borrow money responsibly. Some lenders let you prove this without a credit history. For example, they might ask you for proof that you pay your rent, utilities, and phone bills on time, or that you make regular deposits to a savings account. Other examples of ways to show credit that you're a good credit risk may include insurance premium payments, payments of medical bills, payments for school tuition, child care payments, payment of personal loans, documented by a written loan agreement or canceled checks. Ask the lender to consider alternative forms of history. If a lender is not willing to do this, shop around for one who will. Other questions to consider: have you ever filed for bankruptcy, had any outstanding judgments, had property repossessed or foreclosed upon, or made late payments? These situations may make it more difficult for you to get approved for a loan. However, some lenders will ask you to explain what happened. Depending on your circumstances, a lender might be willing to approve your loan request. Situations that may prevent you from getting a loan at all, particularly if you're currently going through them, include attachment. That's a lien against personal property. Bankruptcy, a legal declaration of insolvency. Bankruptcy will not fix credit problems and will be part of your credit history for 10 years. You must get credit counseling before you can file for bankruptcy. The law also requires you to pay a portion of your unsecured debt if possible. Foreclosure. A legal proceeding initiated by a creditor to take possession of collateral that secured a defaulted loan. Garnishment, a process by which a lender obtains directly from a third party, such as an employer, part of an employee's salary to satisfy an unpaid debt. Part of the employee's salary is taken each pay period until the debt is fully paid. This process must be authorized by a court order, though. Judgment is a court order requiring a debtor to pay money to the creditor. The judgment places a security lien on the debtor's property until the judgment is satisfied, which is the debt is repaid. A lien is a creditor's claim against property to secure repayment of a debt. And then repossession is seizure of collateral that secured a loan in default. Banks will use credit reports to obtain character information. You can obtain free annual credit reports by doing one of the following. Submit a request online at www.annualcreditreport.com. Call toll-free 1-877-322-8228 or complete the annual credit report request form from www.annualcreditreport.com or www.ftc.gov/credit and mail it to Annual Credit Report Request Services, P.O. Box 105281, Atlanta, Georgia 30348-5281. We'll be covering credit reports more in depth during later modules. To determine what collateral you have, the lender may ask, do you have assets to secure the loan beyond your capacity to pay it off? Collateral is security you provide the lender. As we have seen, giving the lender collateral means that you pledge an asset that you own, such as your home, to the lender with the agreement that it will be the repayment source in case you cannot repay the loan. A co-signer can help you get a loan if you're unable to obtain one yourself. This person signs the loan documents with you and is equally responsible for repaying the loan if you cannot. For example, if you do not have a credit history at all, the lender may require you to use a co-signer to get a loan. Here are some important questions you need to ask before you're applying for credit. Do I need this? Do I need this now? Can I wait until I have cash to pay for it? Can I get credit? What's the total cost of the credit including fees? Can I afford the monthly payments? And what is the APR? Once you've decided that you may want to get a loan and have been approved, you should keep these tips in mind to use the money you have borrowed very wisely. Try to pay off your entire bill for credit cards or other lines of credit each month. If you cannot, paying more than the minimum balance due will reduce finance charges and total interest paid. Pay on time to avoid late fees and to protect your credit history. If you cannot pay on time, call your creditor immediately to explain the situation. The creditor may waive the late fees or be willing to make other payment arrangements. Check your monthly statements regularly to verify that they're accurate, and call your creditor right away if you suspect or identify any errors. Ignore offers creditors may send you to reduce or skip payments. You'll still be charged finance charges during this period. And think about any cost difference if you purchase your item with cash versus if you purchase your item with credit. Remember, if you purchase a $500 stereo with a credit card that has a 20% APR, it could cost you $653 and could take 3 years to pay off your debt if you just made the minimum monthly payment. Something to consider. So let's finish our discussion today with some information about predatory lending and how to safeguard yourself against it. Predatory lending occurs when companies offer loan products using certain marketing tactics, abusive collection techniques, and loan terms that mislead and exploit borrowers. Predatory loans are usually more expensive than other loans or have repayment terms many people cannot meet. The best ways to guard against being involved in a predatory loan transaction is to be a good consumer by dealing with reputable loan providers, shopping around with several loan providers of your choice to obtain the best terms, reading and understanding all terms and conditions of an offered loan or asking questions until you're sure you understand, and ensuring you can afford and make payments according to the loan terms. We'll also learn more about this topic in a later module.